Hello and welcome to the Retirement Planning Podcast, your trusted source for navigating the path to a secure retirement. Your host and guide on this journey towards financial peace of mind is Darrin McComas. On this show, we'll delve into everything you need to know about retirement planning, from investment strategies and risk management to maximizing your Social Security benefits and crafting a resilient financial plan using the bucket plan financial process. Join me as we bring you insights from top financial experts, share stories of successful retirement journeys, and provide practical tips to help you build and preserve your wealth. Let's embark on this adventure together as we strive towards a future where retirement isn't just a dream, but a well-planned reality.
Hey everyone, welcome to the Retirement Planning Podcast. I'm Darrin McComas.
And I'm Jason Fox.
Hey, we have a great episode today. It's September. It is Life Awareness Month, Life Insurance Awareness Month. We have a special guest for our audience today. It's Stoyan Petev. Stoyan is the VP of Advanced Markets with Clarity to Prosperity, which is our mothership, we call it. Our C2P by short is what we belong to as far as Prosperity Capital Advisors. And Stoyan is an integral part of C2P. He trains us advisors on markets, life insurance, long-term care planning, things like that. And he's a wealth of knowledge. So we are very lucky to have Stoyan with us today. And Stoyan, like we said, it's September. It's Life Insurance Awareness Month. So welcome to our podcast.
Great to be here, guys. This is an honor and a privilege to be on your podcast and to share some of my experience with respect to life insurance. It's a very opportune time to be having those particular discussions, and life insurance is one of my favorite topics to talk about.
Well, that's good because I think a lot of people kind of their eyes glaze over and things like that, and so. Certainly, having heard you talk about it before, I think the audience is in for a treat to get your perspective on everything.
Would love to help.
Awesome. Well, we know you have a wealth of experience in this arena. But a lot of our audience, they're new to finances. They're new to this financial planning. Kind of just let's start at a very basic level today. What's the difference between? I think when a lot of people hear life insurance, they immediately think term insurance, but kind of walk us through the difference between term insurance and cash value life insurance.
So one of the best analogies that I have heard people use over the years is basically kind of equating term insurance to renting an apartment, right? You rent for a specific period of time. You have the need for the coverage, but you don't want to pay a lot. And that's why you rent for a specific time, whether it's going to be 10, 15, or 20 years. That's what term insurance does. It kind of protects you for a specific time frame. A permanent insurance is, as the name implies, more like owning a house. You pay a little bit more to build equity in the house, and as you get older, and the cost of the insurance to insure you goes up, you start to use that equity to kind of supplement that premium that you have to pay over the years. So that's what keeps the premium level. That cash value is basically the equity that you build into the permanent life insurance for the rest of your life.
Yeah, that's perfect. And for the younger generations who may be just starting out in the workforce and they don't have the disposable income to go out and get cash value life insurance, obviously term insurance could be a great way to protect your family, help pay off that mortgage. But as you transition and as you grow and you start making more money at work, and maybe you're in your 40s and 50s and you're at your peak of your earning years, why should we start looking at cash value life insurance in that season versus just continuing with that term policy?
No, that's a great segue because when I talk to clients and when I talk to advisors who have clients that have that life insurance need, usually young couples have a lot of need for term insurance as they build out their nest egg, as they try to beef up their 401k savings, as they try to have a family and kind of build that house and kind of grow into their wealth. Term insurance is a great bridge to protect them for that initial time frame. And then as you get older and as you have that extra income that you can put away towards something that can stay there for you and for your spouse and for your children forever. Now, life insurance has changed over the years, and initially people bought it just for the death benefit need. And initially, I'm talking back in the 80s and 90s and before. But ever since the turn of the century, and there was uh, an act that was passed by Congress in 2006 that introduced the living benefit into the life insurance policy. And what do I mean by that? The living benefit into a life insurance policy is basically using the life insurance policy to supplement things like chronic illness, things like extended care, long-term care expenses, and use that death benefit or a piece of that death benefit, a portion of that death benefit, to pay for those type of expenses on a tax-free basis. Other people use cash value life insurance predominantly as a tool to alleviate sequence of returns risk, for example. And so, what do I mean by that? Well, life insurance enjoys one of the best tax breaks from the IRS code from a product perspective because it's a self-completing vehicle. It benefits families, it benefits spouses, it benefits charities. So the IRS has bestowed life insurance with three very unique tax advantages. While the premium is not tax deductible, the death benefit, when paid out to the family members or to a charity, for example, is income tax free. So the beneficiaries usually do not pay taxes on receiving that death benefit. Also, the cash value buildup inside of the life insurance policy is not taxed. So it enjoys that tax deferral on the cash value build up inside the policy. So if it's not taxed, as you can imagine, it allows for the cash value to accumulate a lot quicker. Now, if you structure a policy properly in according to the IRS regulations, life insurance also enjoys the income tax-free distributions. And so, what do I mean by that? If you build up enough cash value and you decide to use it as a supplemental income vehicle in the future, any distributions on a properly structured life insurance policy can come out income tax free. And as such, for example, if you look at a retiree that's taking distributions from a 401k plan, those distributions have to be taxed. Those distributions you have to pay a tax on, and they may affect your Social Security taxation. In the instance of a life insurance policy, if you take out those properly structured distributions, they are income tax free. So you can take less of it, and that's where the sequence of returns play comes into play.
That's great stuff.
Great information. You've kind of alluded to this already, or covered a lot of this already, but when we have people come in, we always talk to them about holistic wealth management. So kind of talk to us about, why is life insurance such an integral part of the holistic financial plan?
Great question. It's because anytime there is a liability in somebody's financial plan, life insurance usually can bridge that gap. So it is when you talk about holistic planning, it's you have to also discuss what happens after you're gone. Who are the people that you love the most, and are they protected? What happens to those people if you're gone? Are they going to have sufficient money to stay in the house? Are they going to have sufficient money to support their kids? The kids, are they going to have sufficient money to pay off any debt? That's where life insurance comes into play, and kind of I look at it as a wrapper around the holistic plan that kind of ensures that whatever happens to you, that plan will continue uh, according to your objectives and the needs that you have communicated up front. And whether it's going to be just the protection piece, uh, a lot of people buy life insurance just for that protection because they want to insure those loved ones, and they want to ensure that their legacy stays intact. Those loved ones don't have to do anything out of the ordinary, and lose on benefits, lose on income if something were to happen to them. And life insurance is that protection piece that ties that together. For other people, it's that sequence of returns risk that we talked about. Yet other people, they like the living benefits that cover long-term care and chronic illness, for example. So they want to have that life insurance policy that can be that pinch hitter that can come into play if they ever go into a nursing home, or if they ever need some type of an extended care, and maybe use a portion of that death benefit towards those needs, and then the residual goes to the family in need.
Yeah.
Yeah, makes sense.
We show this graphic all the time to clients, to prospective clients that we're meeting with. And I think the main point here is it really takes all 5 of these components working together to have a great retirement. And if you don't have that protection planning in place, it can blow the whole thing up, and life happens. So, we've lost a few clients the last couple years. And man, here you have a spouse who's grieving. Maybe she's just lost a social security check or a pension check. And we're scrambling, right? We're in scramble mode trying to figure out how we're going to bridge this income gap. And, we talk a lot about life insurance in terms of this protection planning component right here, as well as what you mentioned earlier, tax planning also. It's a great way to mitigate taxes in retirement, as well as leave a tax-free legacy behind for your beneficiaries. So I agree with
a lot of and I'd like to interject here and add one other piece. For example, a lot of people use 401k plans on a pre-tax basis throughout their accumulation years, and once they turn on that income stream in retirement, that pre-tax money that they have enjoyed not paying tax on during that accumulation phase, now they have to pay the tax on that. And let's say mom and dad go through a big chunk of that, and then they leave the rest to the kids. Well, depending on the kids' tax bracket, those kids have to take those distributions, and those distributions may push them in a very high tax bracket. So that's where life insurance can also come into play and say, okay, well, mom and dad can leave that legacy with respect to an income tax-free death benefit that the kids can enjoy, and maybe they can repurpose that pre-tax money to for other purposes, maybe a charity, maybe a charitable contribution, and just leave the tax-efficient nature of the life insurance death benefit to the kids. So it doesn't push them into a new tax bracket and preserves a big portion of that legacy for the parents.
Yeah, I think what you're alluding to there is something that we frequently talk with our clients about, and how to mitigate those, post-death tax implications for their beneficiaries.
Yeah, we're going to do a couple of case studies, and one of those here in a second. It's where they have a large amount in that pre-tax funnel. But before we get to those case studies, Stoyan, kind of walk us through what are some of the biggest myths or misconceptions when it comes to life insurance. We hear some of these when we talk with our own clients.
Well, one of the biggest ones, it's expensive.
Yep.
And I have to sometimes laugh at that because it is usually pennies on the dollar. Of course, the younger you are, the less expensive it is. But term insurance is cheap. The price of term insurance, depending on your age, can be anywhere from a Starbucks latte per day to maybe a couple of Panera uh, meals for a month or something like that. It's not as expensive as people make it out to be as far as term insurance is concerned. So at a minimum, I do advise people to consider term life insurance. I mean, our industry has a great resource in as far as calculators that people can go in and play and figure out what their individual needs may be. They can also talk to you because you're very proficient in that area, so you can help them guide them through the calculation aspect of it. So that's the biggest misconception. People think it's too expensive, and the second misconception that I typically see, it's too difficult to get, and that's also not true because life insurance, you have to go through underwriting because the life insurance company is not going to insure you for more than they think you're worth. And life insurance companies over the years have been very good at calculating what that human life worth is. So they will not allow you to purchase more than your human life worth in their eyes. And they have developed a lot of tools over the years to make sure that more people qualify. So, for example, they have electronic health interviews that they conduct online. They have tele interviews that they conduct with people at their convenience, and they have made that process a lot less invasive than it used to be back in the day. So there are a lot of easier ways to obtain that coverage if you need it. Those are probably the two biggest misconceptions that I see. People think it's hard to qualify, and it's not. And of course, it's going to depend based on your current health. So the younger you are, the easier that is to obtain, and the cheaper it's going to be. So those are probably the two biggest that I have seen in my career.
I would agree with that. Those are the two that we hear most often with clients. But let's go through a couple of case studies real quick before we wrap up today's podcast. We want to get your take on these. These are kind of typical scenarios that we run into when we're meeting with people. Jason, go ahead. Walk us through this.
So case study number one, we've got a married couple, 65 years old, 1 million in IRA money. They got the pension, Social Security, no debt, and then they're concerned with future taxes and leaving a legacy for their loved ones. How would you approach a situation like this?
Yeah, because we see this a lot with people we meet with. You know, they've worked their whole life. They've been contributing that 401k, and they've built up a substantial nest egg. But unfortunately, they have almost all of their money, $1 million jammed up in this pre-tax funnel, and the other two funnels really don't have much to them. And so kind of walk us through, taxes are a concern of these people, but also protecting their spouse and having a legacy to leave behind to their beneficiaries. Let's pretend they don't draw too much on this IRA each year.
Yeah, no, that's a very good case study because most people fall in that category, and a lot of people that I talk to typically want to make sure that they leave legacy to the kids, and one of the best ways to do that is to basically spend that pre-tax money and take advantage of your standard deduction, whether it's going to be a standard deduction as a joint couple, or um, use your basically married filing jointly opportunity from a tax return standpoint to alleviate some of the taxation on that accumulated nest egg into the pre-tax funnel. So what a lot of people would do in that case is say, okay, we can spend this and we don't have to worry about leaving the legacy if we just buy what's called a joint life insurance policy. You're basically leveraging um, the life expectancy of the two parents to buy a tax-free income tax-free death benefit for the kids and or grandkids. And some of the life insurance policies right now, you can basically design so that you can predetermine how that death benefit is going to be paid, in what proportion, in what amount, and it's the planning flexibility is there because now mom and dad don't have to worry about spending down that money because that they have that life insurance in place that will be passed on to the kids in an income tax free fashion. So think about it in those terms. Let's say in this particular example, they have $1 million in pre-tax money, and if the kid's tax bracket uh, is let's say 40% or more, now what you can do is you can buy a death benefit that's actually 600,000, which kind of equates on a after tax basis the leftover for the kids, and they don't have to worry about the IRA or pre-tax money or 401k money, whatever pre-tax account they have it in, blowing up their tax return from an income tax bracket once they inherit it. So it is fascinating what you can do from a life insurance standpoint, and it's pennies on the dollar. If you
Yeah.
have a life insurance policy on husband and wife because they use the joint life expectancy from an insurance company standpoint, the price of that policy is really peanuts.
Yeah, and it's
Yeah.
that's a great way to do it. I think a lot of people understand, you can't put IRA money in a life insurance policy. You have to pull it out of that 401k or IRA, eat the taxes on it. And I think a lot of people understand, that we can convert that into a Roth, right? And that's a very powerful tool to mitigate taxes. But I think another great tool is don't just put everything in a Roth over time. You can also put that, at least a portion of that you had earmarked for the Roth, into that cash value life insurance. Is that a wise move?
That is also a wise move, and there are many different ways you can approach this, and that's the value of having a holistic financial planner kind of walk you through it, like you guys have done and continue to do for clients. And it's because there is no one particular strategy that's the go-to strategy for everybody. Everybody is different.
Yes.
Everybody has different circumstances. Everybody has different needs. Everybody has uh, different allocations within their portfolio. So having somebody like you to talk to makes those decisions so much easier because I mean, in their particular case, for example, if they're in a low tax bracket, maybe a Roth conversion may be a good opportunity. If they're in a high tax bracket, maybe you take as little as possible out of the pre-tax money, and you put it into a life insurance policy to leverage it out for the next generation. Maybe you do maybe you delay Social Security claiming strategies to take as much money out of that pre-tax account as possible, and either do Roth conversions or use it for a cash value life insurance policy as a sequence of returns um, kind of opportunity down the road. So there are so many different ways you can use those strategies, and that's where you guys come in uh, as a holistic financial advisor.
Yeah, I mean, let's face it, this couple, whether they need to take that money out of their IRA or 401k now, at some point when those required minimum distributions kick in their 70s, they're going to be forced to be pulling chunks of that IRA out and eating the taxes. So we preach being proactive. It's probably easier to do it when you're younger. Plus, the more time that money has in the Roth or in a cash value life insurance policy, the more opportunity it has to grow and compound. And ultimately, you recoup some of that taxation hit that you took to get the money in there in the first place. So
one specific example that I wanted to kind of give people kind of a little bit of the use of a life insurance policy if you have most of your assets in a qualified plan, is if you are fortunate enough to start early and contribute money to a properly structured cash value life insurance policy and build that cash value over time. Once you get into your retirement years, and then let's say that portfolio is invested in the market to generate outsized returns going forward to kind of keep up with inflation and keep up with your spending needs. And I mean, we all know that the markets go up and down. So the only thing I can guarantee in life is that the market is either going to go up or it's going to go down. There's no other option, right? And so in those years that the markets go down, you can use the life insurance policy cash value to take money out of, supplement your income, and then let that retirement portfolio recover for future years when you take distributions out of it. And because of the tax free nature of a properly structured life insurance policy, you actually take less money because you don't have to pay tax on that particular distribution. So those are some of the uses of life insurance within the context of the sequence of returns risk.
it gives you a lot of flexibility.
Yeah, I was say that it's a great strategy for mitigating that sequence of returns risk. So absolutely love hearing that and getting more insight into how you utilize that.
I'm going to dovetail off that strategy. I've even heard people during a down market taking money out of their life insurance or cash value life insurance and using it to buy the dip, so to speak.
Yes.
And when markets cycle and they go back up, and if they time that, they don't have to be perfect, but they can recoup that money and grow that money and then pay back that money they took out of the cash value life insurance and end up ahead. So that gives you a lot of flexibility when you have options in retirement.
Yeah, and I think that goes back to what you were saying, Stoyan, is that there is no cookie cutter solutions, right? And there's just so many different ways to approach this, which is why it's so important to be, kind of talking through it and figuring out what's right for your situation, right?
I mean, for example, I use my life insurance policy as my bond alternative.
There you go. Yep.
Because I know that it's conservatively invested, and it accumulates every single year, depending on how the bond markets perform. And the life insurance company pays me an interest to accumulate that cash in that life insurance policy, whether it's going to be dividend, whether when it comes to whole life policies or just interest as it's known in universal life context. But you use that as I use that personally as my bond alternative, and I have my Roth IRAs and my 401ks invested more aggressively because I know that I have that huge anchor sitting in my portfolio that I can always go back to and draw upon without restrictions.
That's great.
It's a great strategy.
Let's walk through one more quick case study, and then we'll get your kind of final thoughts on this and wrap this up. But similar couple, Age 65, they have the same $1 million, but this time it's spread out between those three tax funnels. It's not all jammed into the IRA. They have 300,000 in the IRA, about 400,000 in that non-qualified post-tax account or joint brokerage account, and then they have about 300,000 in the Roth IRA. Same Social Security pension, similar worry, and they're not so worried about taxes because they have some of those other funnels built out. But how is this couple different than the one that has basically their entire nest egg in that pre-tax funnel?
So this is actually a pretty interesting case because you can take many different approaches, and you can go into many different avenues from a planning perspective depending on their specific needs. So, for example, since they have a huge chunk of those assets allocated between non-qualified or also post-tax and
Yep.
tax advantaged, you may not have as big of a need for a life insurance death benefit. However, um, what you want to do is you want to protect those two funnels if you want to protect those two funnels for your kids. What you may consider doing is maybe um, allocating a small sliver of that towards a hybrid policy that has a long-term care benefit rider, and have that opportunity from a planning perspective, because one of the biggest expenses that people will incur in their retirement is healthcare. And if you have that aspect of it addressed, um, between the pre-tax and a life insurance policy with a long-term care benefit or extended care benefit, then you can leave the other two to the kids or grandkids, or do whatever you want with it. So that's one way that you can plan using life insurance with that type of allocation.
I love you. It's like Nostradamus here. You read our minds. That's exactly where we were heading with that hybrid policy. So kind of explain the difference between that hybrid life long-term care policy versus just a traditional long-term care.
So with a traditional long-term care is the biggest concern with that over the years has been what if I never use it, right? It's like health insurance. People are familiar with health insurance, and a traditional long-term care policy, it's you pay a premium that usually goes up over the years, and you basically have a benefit that the insurance companies agree to pay in case you need extended care, whether it's going to be home health care, whether it's going to be nursing home care, whether it's going to be assisted living facility, or what have you, adult daycare as well. So those types of policies are basically ongoing premium, and you pay as long as long as you don't need it. And once you go on claim, then the insurance company has promised to pay a certain amount of benefit, and that goes into effect. Now, the struggle people have with those types of traditional long-term care policies is twofold. One, the premium is not guaranteed, and number two, um, what happens to that premium if you don't need it, if you don't need the policy, or if you never use the benefit? Well, in most cases with those contracts, unless you have paid for the extra rider, you basically forfeit that benefit. So that's kind of one of the grudges people have had with those types of contracts over the years. Don't get me wrong, it's better to have it than not to have it, but still, what insurance companies have been able to develop over the last few years are policies that they're known as multiple names, but typically hybrid policies, asset-based long-term care contracts, um, uh, alternative contracts, or there are multiple names that those are known as. But all of those, typically all the benefits inside the policy are guaranteed. So you may take a prepayment of future benefits today with a lump sum, or you can schedule the premium over 10 years, but everything is guaranteed on the front and on the back end. So you know exactly how much you pay, You know exactly what your benefit is, and you know exactly what kind of inflation option you're going to get on that benefit on the back end. And it those types of contracts address um, all three aspects of what people care about. Um, Live, die, or go on claim. There's always somebody that's going to get paid. And if you decide to walk away, there's going to be always a lump sum that's going to be waiting for you. So if you go on claim, there's always a benefit that will be paid for that claim. Or if you die, there's going to be a death benefit that will go to the next of kin. Um, and by the way, if you exhaust all of the benefits that are attributed to that long-term care policy or hybrid policy, there's still a residual death benefit that will be paid as a burial death benefit, um, and that's why people have gravitated towards those types of contracts over the last few years, because it doesn't matter what happens, somebody gets paid, whether it's going to be you, whether you can walk away with it and do whatever you want with the money, whether it's going to be the facility that you go into, or whether it's going to be your spouse or next of kin, somebody always gets paid.
Yep. And so if we tie that back to this couple, they have 3 buckets of money, 3 different funnels they could pull from to fund that. What's nice about these policies today, and this is, I think, how life insurance and long-term care insurance has evolved, is we don't have to always choose that annual payment or that monthly payment where every year your premium might go up as you age, and and then again, if you decide to cancel that policy, all those premiums you've paid kind of vanish and you lose coverage. Today you have options to do single premium, right? Where you just put a chunk of money in there and pay that premium one time, or to do 5 pays or 10 pays. There's a lot of flexibility in how you fund those policies, but
Correct.
I think a lot of people just assume that there's only one option, and that's just you pay that quarterly or annual premium.
No, it's you're right. You're absolutely right. There's a ton of flexibility, and insurance companies get more creative because they listen to the consumer. And depending on what the consumer wants, insurance companies have those very smart actuaries that they have on staff, and those actuaries are very good at calculating risk, and they always put the options that the consumers want typically in those types of contracts. So, and that's why it's there's not one cookie cutter approach. There's so much flexibility out there that it's all based on your individual needs, and it's a policy designed for you and your specific circumstances.
Right. Yeah. So thank you, Stoyan. Any final thoughts that you would want to share with our audience?
I'm a little bit biased, and I think that everybody needs to have life insurance. If you have special people in your life that you love, if you have causes in your life that you want to bequest, life insurance is the cheapest way to accomplish that. And life insurance, the way I look at it, it's the most selfless gift anybody could ever make. Because in most cases, life insurance is for the people that you love, that you leave behind. So they have an easier life. So they have they can meet their obligations, whether it's going to be financial or commitment wise to kids or grandkids. It's the most selfless gift anybody could make, and that's why I like talking about it. I like educating people on it, and I'm a big believer in it, and that's why I do love it for my family too.
Yeah, absolutely.
Well, we really appreciate you coming on our podcast. As you can tell, Stoyan has a wealth of knowledge in this area as well as many others. But this is why we love being part of C2P, is we have access to people like Stoyan who, when we run into certain cases, we can pick their brain and use their experience and their knowledge to, again, customize something unique for that individual client. And we really appreciate you taking time out of your busy day to join us. And
This was a lot of fun, guys.
yeah, it was.
Thank you for having me.
Yeah, thanks for being on.
Yeah, if you want, of course, we'd love if you subscribed to our podcast, which is the Retirement Planning Podcast. You can also find us at ewadvisors.com. We're on YouTube and all your favorite podcast channels. So again, thank you for joining us, Stoyan, and thanks for our audience for joining us as well today. Until next time, we're signing off. Thanks.
Thank you for listening to the Retirement Planning Podcast. We hope we inspired you to make changes so you can live your best life. If you want to find out more about what we do, or you want to have a holistic wealth and health financial plan, please visit our website. Please subscribe to the podcast and share it widely with your friends and family. Financial planning and advisory services are offered through Prosperity Capital Advisors. PCA is an SEC registered investment advisor with its principal place of business in the state of Ohio. Evergreen Wealth Advisors and PCA are separate non-affiliated entities. PCA does not provide tax or legal advice. Insurance offered through Evergreen Wealth Advisors are not affiliated with PCA. Information received from this podcast should not be viewed as individual investment advice. Product discussions and illustrations are hypothetical in nature and will vary based on many factors, including but not limited to age, health, product, insurance carrier, and product design. You should consult the insurance carrier website and policy for detailed information pertaining to the registration status of PCA. Please contact the firm or refer to the Investment Advisor Public Discourse website disclosure statement as set forth on Form ADV from PCA using the contact information herein. Please read the discourse statement carefully before you invest or send money.